The first half of the year has been very, very strong for the Irish commercial property market. We've seen transaction activity in many sectors of the market much stronger than it was even in the entire year last year during the first 6 months of this year. We've also seen some improvement in pricing, although the market is not homogenous, and there is very, very strong demand from international buyers for prime real estate. Secondary is still quite difficult. So all in all, I suppose transaction activity is significantly up, and we're beginning to see some price appreciation in the market again. It depends which sector you're talking about in terms of where the activity is coming from. I think in the investment side, it's fair to say that the bulk of the demand is international, and international investors are attracted to Ireland for a number of reasons. Firstly, the economic situation is improving. Secondly, the extent to which values have fallen from peak, with average values down at least 65% from their peak in 2007. Thirdly, where yields sit today relative to other forms of investment and relative to other jurisdictions. And I suppose fourthly, the extent of deleveraging that has to happen in the Irish market. So there is an availability of product coming through, both in terms of loan sales and equally asset sales, to enable these investors to purchase. So very, very strong appetite from the US, UK, German investors. In the occupier side, it's quite mixed depending on which sector you're talking about. In the office sector, the bulk of demand is coming from the US, with a lot of technology, pharmaceutical type companies being quite active. And I suppose quite interestingly, over the last couple of months, despite all of the negative press about tax havens, it doesn't seem to have had any discernible impact on the volumes of activity in the occupier market. And I suppose in the retail side, most of the activity is coming from existing retailers who are relocating and expanding to take advantage of falls in rent and more favourable terms on deals at the moment. So not so much international in that particular sector of the market. And finally then, just development land. The bulk of demand is coming from domestic players in that particular sector. There's quite a few trends that I would comment on. I think definitely there's been an improvement in yields, much more so than anybody could have anticipated even 6 months ago. Not driven by any significant expectations of rental growth, but very much driven by the weight of money or the weight of capital chasing prime real estate, which has led to prime office and retail yields hardening over the last 6 months. And I suppose the expectation is that as the rest of the year progresses, that we're going to see further hardening of prime yields, both in the office, retail and industrial sectors. I think at this point in the cycle, what we would expect to see is that the months of July and August will be primarily focused on getting the many deals that are currently in legals across the line and completed. And we're unlikely to see another surge in stock coming available for sale until the early autumn, which is exactly what we saw last autumn. There's also a capital gains tax waiver which runs out at the end of the 31st of December of this year. So we would expect to see some of the domestic players at least trying to get transactions completed before year end in order to avail of that tax allowance. So certainly a busy autumn is in prospect.